Welcome back to the channel. Today we're covering one of the strongest foundations of global accounting, IFRS standards. Whether you're a student, a professional accountant, a business owner, or preparing for ACCA, CA, CPA, or CMA exams, this video will give you a complete and practical understanding of IFRS. Not only what each standard means, but how they work in real life, with examples that make it easy to understand. IFRS stands for International Financial Reporting Standards. They're issued by the International Accounting Standards Board, or IASB, and they serve one global purpose: to bring consistency, transparency, comparability, and trust to financial reporting across countries. Imagine a company in Pakistan creating a joint venture with a company in Germany, or a UK investor analyzing financials from Malaysia. IFRS makes those financial statements look like they speak the same language. This is why more than 140 countries use IFRS today. You'll often see two sets of standards: IAS, which stands for International Accounting Standards, issued before 2001 by the old IASC, and IFRS, which refers to the newer standards issued after 2001 by IASB. Both sets of standards are active today, and IASB replaces old IAS standards only when a new IFRS standard is released. Every IFRS standard has two essential components: recognition rules, which determine when to record something, and measurement rules, which dictate how to value something, along with disclosure rules that explain what must appear in the notes. IFRS affects everything a company does, including revenue policies, loan accounting, asset valuation, depreciation, leases, provisions, cash flows, consolidation, foreign currency conversions, and financial instruments. Therefore, IFRS is not just rules. It's a comprehensive system that builds financial truth. Now let's dive deeper into specific IFRS standards, providing detailed explanations and real-world examples to strengthen your knowledge. IFRS 1 deals with the first-time adoption of IFRS. Its purpose is to provide guidance on how to convert from local accounting rules to IFRS. Key points include the necessity to restate comparatives, provide a full IFRS-compliant opening balance sheet, and disclose reconciliations between old GAAP and IFRS. For example, a company transitioning from Pakistani GAAP to IFRS must recalculate depreciation, leases, provisions, and inventory under IFRS rules and restate past year financials. IFRS 2 pertains to share-based payments. The key point here is that when a business provides employees with shares or stock options, it must record a non-cash expense. For instance, if an employee receives stock options valued at $20,000 vesting over 2 years, the expense recognized each year will be $10,000. This reflects the true cost of employee compensation. IFRS 3 addresses business combinations, which include mergers and acquisitions. Major concepts under this standard include the purchase method, identifiable assets at fair value, goodwill recognition, and non-controlling interest. For instance, if Company A buys Company B for $1 million, and the fair value of Company B's assets is $700,000 while liabilities are $200,000, the net assets will equal $500,000. Consequently, goodwill will be calculated as the purchase price minus net assets, resulting in $500,000 of goodwill. IFRS 5 focuses on non-current assets held for sale, establishing a key rule where the value of an asset must be recorded at the lower of its carrying value or its fair value minus selling costs. For example, if a machine has a carrying value of $40,000 and a market value of $35,000, while the selling cost is $2,000, the net market value is $33,000. Therefore, the asset must be written down to $33,000. IFRS 7 discusses financial instruments disclosures, explaining various risks such as credit risk, liquidity risk, and market risk, including interest rate and foreign exchange risks. This standard helps investors understand a company's exposure to different risks. IFRS 9 is considered one of the most critical standards covering classification, impairment under the expected credit loss model, and hedging. For example, different classifications are made for financial instruments, such as bank deposits being measured at amortized cost, trading securities at fair value through profit and loss, and strategic long-term investments at fair value through other comprehensive income. The ECL model mandates that banks estimate expected credit losses, not just reported actual losses. IFRS 10 outlines the requirements for consolidated financial statements, stipulating that a parent must control a subsidiary, which typically involves owning more than 50% of its shares or having effective control. For example, if a parent company owns 75% of a subsidiary, it must consolidate all assets, liabilities, revenues, and expenses, providing a clear picture of the group's overall size and performance. IFRS 11 distinguishes between joint arrangements, specifically joint operations versus joint ventures. For instance, if two companies collaborate on a mining project with equal control, classifying it as a joint operation means that each company recognizes its portion of assets and expenses in its financial statements. IFRS 13 provides a definition for fair value measurement and establishes a three-level hierarchy for valuation. For example, Level 1 involves quoted prices on an exchange, Level 2 covers prices of similar assets, and Level 3 includes valuation models and assumptions. This is crucial for investment properties and numerous financial instruments. IFRS 15, which governs revenue from contracts with customers, introduces a 5-step revenue recognition model. For instance, if a telecom company sells both a phone and a monthly service plan, it must split the revenue between the device sale and the service contract, recognizing revenue as performance obligations are satisfied. IFRS 16 revolutionizes lease accounting, mandating that all leases be capitalized as both a right-of-use asset and a lease liability. For example, a 3-year office lease is no longer merely recorded as rent expense. Instead, it's presented as an asset and a corresponding liability on the balance sheet. IFRS 17 significantly updates insurance contract accounting by focusing on expected cash flows, risk adjustment, and discounting, enhancing the transparency of financial reports in the insurance sector. Moving to IAS standards, which further complement IFRS, IAS 1 defines the presentation structure of financial statements, while IAS 2 deals with inventories, focusing on the lower of cost or net realizable value, allowing FIFO but not LIFO. IAS 7 breaks down cash flow statements into operating, investing, and financing activities. IAS 8 addresses accounting policies, estimates, and errors, providing guidance on how to correct errors and modify estimates. IAS 12 examines income taxes and outlines deferred tax assets and liabilities, while IAS 16 discusses property, plant, and equipment, detailing depreciation methods and the revaluation model. IAS 21 addresses foreign currency translation and the relevant exchange gains or losses. IAS 24 mandates disclosures for related party transactions with directors, shareholders, and key management personnel. IAS 36 focuses on asset impairment, comparing recoverable amounts to carrying amounts. IAS 38 outlines the treatment of intangible assets, stating that goodwill should be impaired rather than amortized. Finally, IAS 40 deals with investment property, necessitating that any fair value changes flow through profit or loss. IFRS is not just about memorizing 17 standards. It represents a complete reporting framework that ensures companies present their financial performance fairly and transparently. Understanding the logic behind each standard, recognition, measurement, and disclosure empowers you to apply IFRS confidently in any job, exam, or business context. Tell me in the comments which IFRS standard you want a full separate video on. IFRS 15, IFRS 16, or IFRS 9. Don't forget to like and subscribe for more accounting and finance knowledge.